I think what I'm going to do is just give one perspective of one firm who is going to have to think about the impacts of this. And I think it's fair to say, and I think as Matthias said at the beginning, actually it's great now to see a file coming forward which isn't based on post-crisis. It's generally about thinking about creating financial regulation which is fit for the future and will work across the EU. So I'm going to give a relatively brief presentation, just some general thoughts, and then I will obviously pass on to another market participant who may have a slightly different view, but I think there is a fair amount of commonality. Okay, so we're not a law firm. What are we? So we are, as I said, about 200 years old. We have about 10 million customers. We are one of the world's biggest asset managers. I used to change the figures from euro to pounds, but I don't bother anymore. I just interchange, because it's roughly 1 for 1. So I gave up halfway through. So you'll see euros and pounds. The value is now the same. So roughly about, apart from the dollar figure, so we use that one. So about $1.2 trillion of assets under management. And alongside traditional insurance, so life cover, critical illness, we also undertake, for example, direct investments. So we are a large house builder. We will support student accommodation, hospitals, universities, so a large building programme. In the last few years we've invested about 12 billion, we have an aim of about 15 billion. And I think it's quite important to think about this in terms of what the Prudential regime will mean for us. This is much less about marketing, but just trying to get a feel for the sort of company that we are. So, okay. Doesn't want to move forward. Just going round. Nope. I am pressing the same button, I promise. Any idea, Adam? Hurrah. So, before I talk about the specifics, for us, whenever a regulatory file comes forward, we put it through what we call 3 tests. They're relatively straightforward, but for us it's around our customers. Do we think it delivers a positive and fair outcome for them? So does that mean, for example, it allows us to deliver the products which they want? Does it allow us to do it at a price which we think is reasonable? And does it allow it to be done in a safe way? As I said, if you've a firm who's existed for 200 years, financial stability is key. But at the same time, we're very conscious that tomorrow's large firms are today's small firms. So it has to work across the piece. There has to be competition. And finally, and I think this is probably one of the most important, is around growth. Without growth, there isn't a market. There isn't really an economy. So we need to make sure it supports jobs and growth and GDP growth. And I think it's probably fair to say that we think this file does all 3. From our perspective, and when I think about this, CMU would aim, in our view, is to make sure that banks rightly have an important role in financing the economy, but through CMU we can increase the diversity of funding available across the union, and to do that in an organised and sensible way. Now, that also means, from our view, we would expect, at the aggregate level, it would be slightly odd if this regime brought through, at the aggregate level, a higher level of capital requirement than currently exists. Now, that doesn't mean that for some firms they might see an increase and other firms will see a decrease, but at the aggregate we suspect it will see a reduction. I would also say this coming from a group, we also are mindful that this regulation needs to work alongside, for example, so the parent company of our asset manager being an insurance company, obviously regulated through Solvency II, but then how does it work with MiFID, UCITS, AIFMD? So it's just to think about the totality of all of it together, just to make sure that there aren't any unintended consequences. Now, I'm not liking this. Opportunities. I'm going to give up on this and just ask someone at the back to move forward, because when I press forward it jumps to the end, so I'm going to leave this one alone. So opportunities, has already been said, so we've obviously trying to move away from the CRD, CRR approach to one which is more proportionate, and I think then reflects the risks that investment firms have. Indeed, many of them don't act as principal. And therefore, we are very supportive of the K-factor approach. We think it can allow the regime to be tailored, we can adopt it to different business models, and we think that's probably fair. If it's implemented properly, then we'd actually see what it could be characterised almost as a regulatory dividend. And I'll go on to explain what I mean by that. I'm really pleased from the EBA approach. When I was looking at the formula, I was very keen on how you could disapply a K factor. Now I've worked out that the coefficient can be times by 0. As a non-accountant, even I can work out this is effectively disapplying it, which is positive. A number of firms would be concerned about what that could look like, for example, if they don't hold client assets. Again, I think for the first time, when I think about it from a conduct and a prudential regulation perspective, I think this is a very interesting file in the sense that it allows conduct or operational risk to flow directly through to the prudential capital. And I think, certainly looking at it from a UK perspective, it starts to bring the two sides together. And I think starting from that approach will deliver positive outcomes. I think the other opportunity for this, I mean, most firms will talk about reporting. I'm relatively relaxed about reporting. We're a large firm. We employ about 10,000 people. We can deliver whatever reports are required in whatever format. If, however, you are a smaller firm, trying to get that right, it does create more of a challenge. So again, I think that is an important opportunity. So from opportunity to challenges, we are still slightly concerned about what the calibration will look like. I'm sort of mindful that for Class 2 firms, although I don't want to weigh too much on AUM, you will potentially have firms with 1.2 billion up to multiple trillion. So thinking about those coefficients and thinking about the sensitivity and how that process comes together will be absolutely key, because clearly multiple trillion versus single billion should have a very different approach. I'm encouraged from what I've heard throughout today and previously that this probably will be okay, but I think a firm will always be nervous until it sees the final outcome. I'm also conscious of the fact that simplification, well, yes, that's great, but is it so simple that actually it doesn't deliver the intended outcome? So for us, and I think it's come through already, key would be around thinking around the business strategy, the products on offer, the level of leverage. All of these will be key in thinking about what those sensitivities are when it comes through to the supervisors at local level deciding what the capital requirements should be. To give an example, thinking around the coefficient which will be looking at the number of trades, well, for me actually the complexity of trade, how liquid the settlement market actually is probably more important than the actual physical number. And again, I think that's a challenge which we need to work through. That then sort of leads us through then to thinking about actually what is the business model? What is the risk appetite of a firm? Has a supervisor deemed the firm to be red, amber or green? You know, should a firm which is deemed by the regulator to be doing the right thing receive that regulatory dividend? My argument would be yes. To take an example, if you had a firm who does hold client assets, which had never had a breach in, say, the last 30 years, should they have to hold the same level of capital as a firm which has a breach every week? So I'm hopeful within the sensitivities and the calibrations that can come through. Then I think the final one, and this is where simplicity versus delivery will come through, is that it doesn't create too many undue operational difficulties. And what I mean by that is that I'm mindful a number of files, whether from European level or from national level, is actually trying to road test how they'll be implemented. Because I think in the past we've seen attempts to try and get legislation there very quickly, but we haven't then worked out how it will be practically implemented, which has then had to lead to either Parliament having to decide there is going to have to be a slight delay, or the Commission wanting to do a rethink, or Member States trying to take a slightly different alternative. I think here we do have an opportunity to see if we can road test how it will work, road test the reporting, road test whether firms fully understand and comprehend the requirements across the Union, not just concentrated in a couple of countries. So, very briefly, from the challenges, we'll go on to what we think is going to work for everyone. Well, if you can get anything which works for everyone, as I was saying before, if you can please half the people a quarter of the time, we think you will have done well as regulators. So on that basis, we want to see balanced and effective categorisation. We do believe that you need to maintain the current high thresholds under CRD, and if I should have really made that "and" word very large, for systemic and bank-like. I think that's quite key. And then I think I would be very surprised on that basis if an asset manager operating on an agency basis was anything other than Class 2 or Class 3. We're also slightly concerned for smaller firms about the thresholds for Class 3. So for example, if on the 31st of December they are 1 billion, A new client comes along, or the markets go up, or something happens, and it's all on an agency basis, and they go to 1.2 billion and 3 cents. Does that 3 cents automatically trigger them becoming class 2? Does that then mean they're going to be stuck on that? So is there some ability to have some sensitivity or some common sense? Now, I appreciate trying to write something which allows for that without somebody then taking advantage of it could be complex, but just something around that to help the smaller firms. And again, I've been actually the final one for us, which is probably the key one, but again, very sort of relieved to hear from today, actually focusing in on what the business model looks like. Because I'm a former regulator and a former policy writer in the UK, and actually a lot of it and how it gets interpreted, how it gets implemented, and then in effect what the outcome will be, i.e. I think there's a shared outcome to get more funding from more types of firms. That won't be delivered if you're not really looking at the business model when you're applying how much capital will be required. I say this as a firm which is ultimately regulated by Solvency II. So that was the shortest version I could do because I'm conscious of time and that we're running slightly over. For those who are interested, this is Cardiff, which is the capital of Wales. We're investing about several hundred million into the redevelopment in the centre. So if you do happen to go to Cardiff, I'm sorry at the moment, it does look slightly like a construction site as the rebuilding continues, but it's an example of one of the projects of how actual capital markets are working to try and improve the physical infrastructure of parts of the EU.